confirmation
It's
hearings,
all over the headlines in business and the hallways in Congress. NIRP. It stands for negative interest rate policy. That's where depositors, in effect, pay a bank to hold their money instead of the bank paying the depositor some kind of interest payment. Now, the reason it's getting so much attention is because a number of major central banks around the world have recently adopted this policy because they want banks to lend out money to businesses rather than stash it at the central bank. Now, it's all about that relationship between a central bank like the Fed or European Central Bank and its member banks. Many central banks require that member banks hold a portion of their deposits on reserve. They get paid interest on that money. But banks can also deposit money above and beyond that required amount at the central bank. Those funds are known as excess reserves. These days, many banks are being more conservative and holding excess cash at the central bank. So, central banks are trying to encourage banks to put their deposits to use by charging them to keep funds rather than paying interest on them. That's what a negative interest rate is. And it's new, spreading all across the world. Right now, you've got Denmark, Sweden, Switzerland, and the European Central Bank and Bank of Japan with similar negative interest rate policies. As for whether or not it works, many experts feel it's too early to tell. The world of negative rates has only been around for a few years. Now, it's not in the cards for the U.S. just yet, but just about everyone on Wall Street is watching closely to see if it could become a possibility down the road. For Nightly Business Report, I'm Dominic Chu.